Well, I just thought, I don't really have a prepared presentation here, but I just thought I would talk about what I've been doing lately and what works, what doesn't work, and just a little update. It was a while back, I guess maybe a year and a half ago, I did my last presentation on calendar spreads, and that's still sort of my roadmap. Essentially, I sell an option about 60 days out, and I buy something about 90 days out. And essentially, what you're doing is you're bullish and bearish at the same time. I don't have fancy ways of predicting which way the market's going, like Mark Sebastian does, but it can go up and down, and I've got a bunch of squiggly lines here that may not make much sense. But anyway, my approach has been let's go bullish and bearish at the same time using calendar spreads. And we're profitable over a range, both up and down. And if the market goes, way directional, either up or down, we layer on more calendar spreads. And so that's been working pretty well. And so what I've got here is an example of a new entry. So August 31st is, let me see. I'm doing these in the weeklies too, although I prefer to stay with the monthlies. But let me see, August 31st, I'm just looking at my other screen here, 68 days out on the short leg, with September 30th being 98 days. So there's a 30-day spread between the front and the back. And it gives you this range on your analyzed chart. Now, obviously, with the analyzed chart, there's different ways of looking at this thing. You could take the same trade and scrunch it up like that. And this is what you're really doing, but it fails to show you the granularity of really what kind of range you've got here and what sort of slope you've got here. And so, there's a little bit of a scaling issue with these charts. And so my solution here has been to have a price slice 3% up and 3% down. And I've found these things to normally stay within that range. And so the way I'm setting these things up, and I'm trying to get back, I spread this thing horizontally so that I can see every $10 strike in here. About like that. And then I want to have 3% down and 3% up on the far extremes of my monitor here. And so what this is doing is it's kind of giving me a somewhat consistent frame of reference so that I can see the slope of this T+0 line. Really what I'm doing here, it's part science and it's part art. And I am kind of eyeballing the slope of this T+0 line, because having a flat T+0 line gives us the ability to withstand momentary moves in the market that can be huge at some times. So, if we can tolerate, this is going to change based on volatility levels, but if we can tolerate a big move up or a big move down without getting absolutely obliterated, then we can handle a lot of things that the market might throw at us. So this would be a standard entry. And then say I'm going to just move this price slice. Say the market has gotten up here and we're like, worried about this thing blowing out the top. Say it's up there somewhere. What I would normally do is add another one of these and put it about at the money. So in this hypothetical situation, we've gone up to say 43.50. So I would add another calendar spread up here at 43.50. And possibly even farther, depending on the momentum in the market. Now, something else I'm watching on a day-to-day basis, you can see over here on the left-hand side, I've got $ ADD, and this is the advanced decline curve. And I've just got this on a 1-minute chart. And I found this to be a fairly good indicator of how strongly we're moving up or moving down. And you know, in my view, a strong reading would be plus 1,000. That would be fairly bullish. A strongly negative reading would be minus 1,000. That's fairly bearish. You know, anything in between is, say, anything below 500 is fairly neutral, from plus 500 to minus 500. And so I'm looking at this thing on a daily basis to decide, okay, you know, the question I'm always faced with is, do I need to adjust? Do I need to worry about this thing blowing out the top, or is the market kind of calm today and, you know, maybe I can at least defer that decision until tomorrow? So when the market opens at 9:35, I'm watching this advanced decline to see how strongly we open, and are we falling off like we did this morning, or are we going straight up? You know, if advanced decline opens at, let's see, what did it open this morning? It opened around 1,760. That's a super strong reading, but what did it do in the next 15 minutes? It went down and down. And so I could see the steam, and you can pair this up with the price chart too. Let me turn off some of this garbage here. Let's see here. Okay. And I'll talk about these indicators in a minute. But so today's move, you know, the steam blew off of it fairly quickly. And so I was like, okay, well, I don't have to worry about blowing out the top today. And so, you know, we'll see what happens tomorrow. But anyway, as the market moves around, if you'll layer on these spreads, we could even put this a bit higher. And so some people might ask, well, how are you deciding where to put this adjustment? See, I just moved it up 25 points to get out in front of the market here. How are you deciding where to put these on? Okay, I'm looking at the Greeks on the trade, and I'm using delta as a indicator of how directional my trade has become. If delta is 0 or close to it, you're neither bullish or bearish, and which is a great situation. You could just let time pass along and you're making money. So we try to keep delta fairly neutral, but see, like, let me turn off this adjustment. Okay. And this is just a 1 lot. The magnitude of that delta is going to increase depending on how many contracts. Let's just throw up a 10 lot so you can get a feel for how I'm using delta here. But in this case, you know, let's just say the market's moved up to 43.54. It's getting way at the top of our profit tent. We're starting to get a little worried about it blowing out the top. And our delta reading is -23. So you could think of that as your trade has gone bearish by 23 pips or whatever. It's just a unit of measure in my mind. I'm not, you know, that this is not the textbook definition of delta, but this is how I'm using it. So ideally, watch delta as I drag this price slice around. So really, that -23 is telling me we need to go down. And so you can drag this around and see where is neutral on the chart. Well, it's not quite at the, you know, it's not quite at the midpoint of our profit tent, but it's close. So anyway, how am I deciding where to place this this adjustment, you know, the degree of delta is going to depend on how far we've moved from our original trade. But I will look at the delta number along with the simulated adjustment. Let me see, we're going to have to crank up the number of contracts here. Okay, see, with this adjustment I just layered on, we brought our delta close to neutral again, which is a great situation. And if you look at the profit tent, we are right in the middle. You know, it's a pretty long ways to blow out the top or the bottom, which is just great. So you can go fishing or go on a bike ride, whatever you like to do. And I'm just going to simulate the passage of time here. Notice how, as time goes by, we're building profit in this trade, and our break evens are expanding both to the up and the downside, which is a great thing. It gives us an even larger range I call it the range of comfort. We want to stay really in the middle of this thing. If we could stay between our two strikes, that's great, but we don't want it falling off the bottom here. But worst case scenario, you turn on the TV and, you know, whatever has happened that's moving the markets, you can always go to cash. You know, take whatever profits. You would be moving down this slope, which gets steeper with the passage of time. So, you know, you can always go to cash as a safety measure in case the market is really whipping up on you. But normally this is what I'm doing. Now, I've got a few traders I trade with who are a bit impatient. They're like, oh, but 60 and 90 days out, that's so long. I don't want to sit around waiting for 60 and 90 days. What can we do? And so, you know, everybody knows the most theta is earned in the last 30 days. And so I've got a few simulations here of different ways to handle that. So let's say you don't want to put something on 60 days out. You want to do something a little closer to expiration so you can make money a little quicker. Okay, so let's see, what is September 17th? That is, no, wait a minute. Going the wrong way with that. July 30th. Let's look at this one. Okay, and let's roll the time back to today. Okay, July 30th. So what I've done here, July 30th is how many days? 36 days on the short leg. And I'm going about 2 weeks out for the long leg. And this is giving me a pretty flat T+0 line. If I moved my long leg to, let's see, July 30th, let's go to August 30th. If we had a month between the short and long leg, that kind of works too, but look how much slope we're getting on this T+0 line. We really have a lot of slope here. So if the market, I mean, it doesn't look so bad for a 1 lot, but what if you're trading 10 lots? Okay, so the market takes a 30-point spill. Well, let's just say a 60-point spill. Okay, you're not even out of the profit tent, but you're very close, and you're down $3,400. That's not a fun situation. And the problem here is the shape of this T+0 line. And again, you really have to have the scaling set, 3% up, 3% down, able to view every $10 strike, at least for Thinkorswim, in order to see this is a gradual slope down, but that's no good. We're not really properly managing our risk by putting on a trade like this, because even a smallish move in the market, say the market drops 50 points and you're like, oh my goodness, what am I going to do now? And then the next day it's another 50 and you're like way down here. And so this is a bad situation. But again, we want to try to trade a little closer to expiration than my normal monthly strategy. And so what we can do is tighten up this expiration. So we're short July 30th. And let me just think through this here. Let's go to August 13th. Look how much flatter that T+0 line got. And I'm going to step it in even tighter. August 6th. Now we're really flat on that T+0 line. Okay, well, you might be saying, but Mark, counter spreads make money based on the differential in time decay between the front and back leg, which is true. And so that you might say that's not a good idea. Well, I've done a bunch of these and it still seems to work. Now, is it working better than the monthly? I don't know. The jury's still out on that, but these things do work with even 3 days between the front and back legs. So that's just a variable I'm manipulating and playing with, and I don't have any positive back testing or anything like that to say this is a great idea or this is not a great idea. But in my mind, a graphical representation of managing your risk is having a super flat T+0 line. So this is a fairly large trade I've got here. I got a 10-lot trade here, and look how flat. We're pretty flat over a big range here. And so this is one way if you want to trade a little closer into expiration. You might consider tightening up the spread between the front and back leg. Now, let's go the other way with that whole conversation. Let's say, okay, your grandmother just died and you inherited $1 million, and you're like, well, I want to grow that money, but I certainly don't want to lose it. Okay, I'm going farther out in time with my big money trades. September 17th is about 85 days. So I've done this up to about 90 days on the short leg and 120 days on the long leg. So let's see, September 17th and October 15th. October 15th is 112. So we're approximately that 90-120 ratio there, a little bit shorter, but notice how flat our T+0 line is over this huge range. And this gives us comfort to just sit in the trade day after day, not really having to do much. And as time goes by, I'm just simulating the passage of time. As time goes by, our T+0 line extends, and we even sometimes goes outside of our expiration graph. And so this is a way to handle larger trades. So you want to put a lot of money to work, but you don't want to be too close to expiration. In my mind, this is all about managing your risk, and your risk management is illustrated by how flat this T+0 line is. So many people are looking at this expiration graph, and that's great, but we really want to get out of these before expiration. We don't want to hold all the way to expiration, because there's always something that happens and you get a big move and you go from $10,000 or $15,000 up. Well, it would depend how big you're trading, but you might go from 10 or 15 up to 0 real quick. And so over the long run, you're going to be served better by taking profits and putting on a new trade. But anyway, for managing a larger account, go farther out in time and just let these things ride. And you stick with the same adjustment scenario. If it gets too high, we'll add another one in. And anyway, so those are some of my current thoughts. Now, another thing that I've kind of discovered, let's go back to my original formula of the 60 and 90 day. Okay, well, say you put this thing on with 60 days on the short leg and time has gone by. So let me see, if we put it on today, what would be, see, today is June 24th. Let's go to let's go to July 26th. So you've been in this trade a month. We put it on today. You've been in it a month. You're up $3,900, or maybe the market's moving up here. Okay, you're up some money. You're no longer in the middle. Maybe you're up 2,500, but you also are looking at this, like the market's been just constantly marching to the upside. And so you're kind of faced with making a decision, but we're also 30 days into this approximately. We're getting you know, on the short rows as far as getting too close to expiration. So what if we were to make an adjustment, but I've discovered a new twist on the adjusting here, and that is, let's say we felt like we wanted to add at about 43.75 here. And let me get that up here. Okay. And with the after hours quotes, I don't know if it's going to really show, right? Because if you put a trade on with 30 days to go, you're going to have a lot of slope on that T+0 line. So what I'm doing on these late stage adjustments is bringing in that back leg so that we can keep a flat T+0 line. So if we're short August 31st, let me see, September 17th. I don't know that this is modeling out exactly with these after hours quotes and some hypothetical move in the future. But you will see if you manipulate the time between your front and back leg for these late stage adjustments. So I would consider late stage being under 30 days. My recommendation in the video I did was to go on and take profits at 30 days and put on a new trade. And you can certainly do it that way, but a more aggressive approach would be to let it ride on past 30 days, possibly even to the last week. But you may have to adjust along the way, depending on market movement. And so the way to handle those late stage adjustments is tighten up the spread between the front and the back. And I found that to work really well. And one thing that I do is I like to look at the adjustment by itself, both with my previous trade and by itself, because I want my adjustment to be an attractive trade on its own, even without considering what's going on with the original one that it's paired with. But here again, we are, let me see. So say the market's moved up here and we're kind of getting delta negative here a little bit, but these we got two 10-lot trades on, so that number is not as big as you might think. And then another metric I've talked about that I look at is the delta to theta ratio. So again, I'm not totally sure that these numbers are realistic, because we're a hypothetical move to the upside and hypothetical move forward in time. But if we took 49 divided by 223, okay, that's 22% delta to theta, which is getting up there. So you might want to adjust this, but then again, you might want to look at the price chart and go, okay, well, are we bumping up against resistance? You know, what's going on in the market? What's going on with our advanced decline line? You know, if the advanced decline is just being, say we're hitting previous all-time highs, and day to day we're watching our advanced decline and it's barely getting over 500, we probably wouldn't worry too much about it blowing out the top until we see some more strength in the advanced decline. So anyway, that's just some of my thoughts and some of how I'm managing these things. And anyway, are there any questions? Let's see.
Someone, please ask, just turn on your mic really and just ask some questions to Mark.
Mark, it's really interesting that you said you had a trade where it seems to work even if it's close, the front and back month are close together. I've tried doing 3 days apart as well with some success. And even I tried one where it was the same day expiration. It was a quarterly and a monthly, or a quarterly and a weekly. Same day expiration. One was obviously, European versus American. Excuse me, it was PM versus AM. And what you're really risking there, what you're betting on, is that volatility will go up, right? And the options will become more expensive than what you paid for it.
Right. Or it's time decay too. You're trying to. I guess you're betting that the movement in the market is going to stay within your range.
Well, I'm saying when the expiration is different, like the AM and the PM, they're pretty much lockstep with one another.
I would think, but there's going to be more open interest on the monthlies than these the weeklies. But I've traded in and out of the weeklies just fine, and I mean, my gut feeling is it would be better to stay in the monthlies. But if you start doing this adjustment maneuver I'm talking about, tightening up the front and back, you can't do that. But it's also timed expiration on the front leg. I've found under about 30 days that the things get really, really wonky. Let's say we're really impatient and we want to put one on for July 16th. So let's see what that would look like. July 16th, let's move this back to say about 42.75. Let's see. Okay, let's just say you're really impatient here. 42.75 July, and then where's our July 16th, July 19th. Let's look at that. Let me move the date back. There we go. Okay, that's actually not horrible. It's not a horrible graph. I'm seeing a pretty flat T+0 line. I mean, it's definitely a narrower range than our monthlies, but we're also betting on less time between now and expiration. What would be an even shorter one? Let's look at that. Let's just say we want something 2 weeks out. So we might do July 9th. All right, now we're seeing some slope on our T+0 line, but we got July 9th and July 19th. And it would be even worse if we went farther out with our long leg. Let's just say we were, see how much slope we're getting here? We got very tight range of safety. There does not have to be a whole lot of movement before we're stuck having to adjust again. This is not a trade I would want to do, but let's just move this July 9th to, let's see, move our back leg to July 12th. This is not a horrible graph. We've got a very flat T+0 line. Yeah, the range is not huge, but if we're trying to do some short-term stuff, this might be one thing you want to do. But again, I want to see this T+0 line pretty flat over a range so that I'm not sweating with every up and down tick of the market, because really, it's very hard to predict where the price is going. I mean, some of the smartest guys in the world get it wrong over and over. And so,
check out, Mark, the July 16th monthly and the July 16th weekly.
July 16th monthly, July 16th weekly. Well,
Yeah,
that's interesting.
yeah, I've traded this. You get eaten alive with commissions,
Yeah.
but so actually I've traded this before, and I had, I don't know, 5 or 6 of them in a range at every 25-point mark, and it's incredibly flat. But like I said, you're just waiting for volatility to spike because
You're not you're not putting a whole lot of money to work there. For 10 contracts,
right.
you're like 850.
Yeah, you can expect to lose around 3% of your profit on commissions alone.
Yeah, and your commissions are pretty substantial on that 10 lot for what you're making. So, I found the most lucrative things to be the ones that I can take closer to expiration, and I'll just show you some of my live trade. This is a live trade I'm in right here. It's a 21 lot. And I've adjusted some things up and down. One of my rules, though, here is if you've got a calendar down here and it's over 100 points from at the money, you need to take it off. I found at least 100 in the SPX. If it's over 100 points from at the money, it's not doing you much good, and you'd be better whether it's a win or a lose. Well, maybe you make a little on that one, depending on how long you've been in it, or maybe you're down a little bit of money. I would still recommend, if you're over 100 points, take that thing off and move it. But this is one I've adjusted around and managed to stay in from, let me see, when did I get in this thing? See, I've scaled into this from May 27th. I added some again on June 4th and June 10th. And so this is for July expiration, which is 21 days away. So I'm probably going to take profits on this pretty soon, but you can see how well these things can work. This is a big trade, and I wouldn't recommend this until you've got a lot of experience here. But, that one's rocking along great with 21 days to go.
Somebody in the chat, Mark, is asking what your capital at risk is in this trade.
Well, I can tell you, and the way I usually answer that question is just drag the graph over here, and that's about 58,000 right there. So like I said, this is a big trade. I would not recommend this for unless you got a lot of experience with this. But again, I can tolerate a huge move. I'm up some nice money here. Yes, I don't want it getting away from me. The likelihood that we're going to blow out the bottom, it's a possibility. The likelihood we blow out the top, probably not. But it's a huge range. I really don't start losing money till down here around 41.35 on the bottom and 43.75 on top. So I put this on a while back. I've scaled it. I guess I've been in it over a month now, bits and pieces. And so anyway, that's what they can look like when they're working well. Now I scale out, so that's my July, August. Now, what I've also got some August, September. Now, when you're working multiple time frames, you have to be very careful about stepping on a leg from another trade. So like between July and August September, well, in that August month, I'm short and long various strikes. And so you have to keep them grouped in the right group, and you don't want to step on a leg making an adjustment because they'll cancel each other out and mess your trade up. But this is what I've got going for August, September. Now I'm up a little bit of money, and I have not been in this very long. Let me see. 6-4. So 20 days on that leg. I think I've added to this thing. Let's see. 618. So I added this first one down here, and then as the markets moved up, I've added these other strikes, and there's no rule of thumb, spacing between the various calendars. I'm just looking at the Greeks, and so look at my Greeks on this one, 0.78 delta. So I'm like neutral, totally neutral on delta, and theta is a nice number, and it's a long time to go here. August is, how many days to August? 56 days. So this is close to a new entry. And you can see I've just got this huge range that I basically don't really have to sweat a whole lot as long as the market stays within these boundaries. And so I've got more money out here okay, I'm doing a little experimentation here. I'm short September, which is way on out there. And then I did 60 days between front and back leg. Okay, September is 84 days. And November is 147. So anyway, based on the theory that these make money with the differential and time decay, I've gone 2 months between front and back on this one. And so this is sort of an experiment. We'll see how it plays out, but we've got, again, a super flat T+0 line over a pretty big range. And if we can just get a little time in the trade, that T+0 line goes up, which extends our break evens. The little red hash marks are our break evens. It extends them out with the passage of time. And so if we can just sit on this thing long enough, we're going to be making some nice money. So I'm just clicking through the days, but if I can hang on to this till, say, early August, we're going to be up some nice money. So
Mark, what is that, about 30, 45 days?
Yeah, something like that.
That's typical amount of time that you hold. And then what's your typical return on average?
Well, a lot of times I've seen these things make about 20% a month, but it's going to depend on market movement, how often you got to adjust. Sometimes the market moves so big that we have to take these things off at a small loss and reposition the money. So typically they can make 15 to 20% per month, but then there are months that things just don't seem to work right. It's surely some adverse moves and volatility, and too much market movement is blowing you out of the water. And so out of every year, I probably have 1 month or 2 months where things go sideways, and I'm just struggling to hang on. And then maybe the other 10 months out of the year, I'm making a pretty nice monthly return and able to compound that to the next month and the next month. And so that's kind of what I'm doing. And I'm also diversifying across time, having some shorter ones, some medium term, and some longer ones. And let me see. Here, I've got a little cash trading account, cash brokerage. This is what I've got going on it there. There's not a huge sum of money in this account. I've got about, there's about 20,000 in this account. So because this is not an enormous account, I am again experimenting with a shorter time between front and back legs. And you can see I've got a pretty flat T+0 line. I've extended my range a little bit by stacking some other calendars in here. Again, notice our delta and theta. Delta is -7, so we're ever so slightly bearish. Neutral would be about 42.55, and we're just above that. But if the market keeps moving up, we will keep adding calendars up here. And if this lower one gets to be 100 points from at the money, I just take it off, no questions asked. Whether it's profitable or it's not. Sometimes it is profitable. With the passage of time, you could still be up money on something that's 100 points away, but it's diminishing returns, and it's staying on top of where the market's going, whether it's going up or down. So anyway, that's just some of the variables I'm playing with and how I'm managing these things. Let me see. Got another little trade here that I think I just put this thing on, so it hadn't even started to make money. But expirations, I'm short July 30th, which is 36 days. So this is about a 2-week spread here, front to back. This is giving me a decent graph, so I'm rolling the dice and going with that. Let me see. Back to my big trade. Let's see how the Greeks are on it. Okay. Back to this big trade. I'm negative 47, which, okay, this is a big trade. So the magnitude of this delta is related to how many contracts you're trading. So in order to put that into context, we look at the delta theta ratio again. And so in this case, I would go 47 divided by 675 is, it's about a 7% delta to theta. So, that's okay. And anyway, I'm not sure what else to say about all this, but this is how I'm managing things, and the things I'm looking at, and I'm watching the VIX day to day. If I see falling VIX, well, Mark Sebastian did a much better job with VIX than I could possibly do. But if I see falling VIX, I know the market's marching to the upside. And if I see falling VIX and advanced decline is up and getting stronger, then I know that the upside could be in danger if we got a lot of strength in the advanced decline and VIX is continuing to fall. And so I might, given those factors, I might get out in front of it a bit sooner, or even adjust this thing so that I'm delta positive. The plus or minus here on the delta is telling you which way you really want this market to go. So let's just go to our simulation again. If we were exceptionally bullish on the market, we would want to get out in front of it a bit. I mean, you could put on something like that. You might want to do it in the calls and see what our Greeks are here. We got a delta of positive 15, which means it's positive. We want the market to move in a positive direction, and our delta theta ratio is fine. And in this case, if we were bullish, we're positioning up above the money. So with the passage of time, we're moving to the meat of our profit tent rather than down here on the tail. And you could even do this to a more extreme. Let's see, what if we went up to 43.25? Well, that's very bullish. And, you may or may not want to do that based on your analysis of the price chart. But that's certainly something you could do. And if the market had bottomed out and it seemed like it couldn't go any farther down, you might get out in front of the market with a move like this and have the passage of time and the movement of price come to the meat of your profit tent. So that's just some of the things. I'm not really always delta neutral. If you have no idea where the stock market's going, then sure, delta neutral is fine. But if you have any opinion that might hold some water, you could play it slightly directional or heavily directional. But I think of this delta as sort of a micrometer type dial, which you can turn it slightly bullish, slightly bearish, And you can, I'm not readjusting these things day to day because I tolerate some up move and some down move. And of course that delta number bounces around plus or minus, but generally, I'm looking at that to tell me how bullish or bearish my trade is, and whether that lines up with my gut feeling and what I'm seeing in price movement, and certainly the AVD, advanced decline, and the VIX. I'm looking at all that stuff and forming a gut feeling, I guess, based on which way the market might go. But if you have no clue, or you don't feel like you've watched the advanced decline long enough to really be able to discern it, then a good fail-safe approach would be you keep it relatively delta neutral and just roll with what the market dishes out, but keep your adjustments. You want a flat T+0 line on each of your adjustments so that you can tolerate a lot of movement in the market without getting hurt too bad. So anyway,
hey Mark, thanks for doing this. How sorry, I'm just trying to model some of this stuff over in option view, and their modeling is different and all that kind of stuff. Supposedly it's supposed to be more accurate, looking into what would happen, but you've obviously been doing these a long time. How accurate is the Thinkorswim model when big jumps do happen?
It's been accurate enough for me. I mean, we're all familiar there's a lot of calculations behind these numbers, and there's lots of debate as to whether whose Greeks are better than somebody else's Greeks. I mean, it's a seat of the pants number anyway that's constantly changing. It's kind of like you and your buddy both have Corvettes and you're racing each other, but the other guy's speedometer and tachometer read a little differently. Well, you're both going down the same road and you're trading the same stuff. So I don't know. It's not been a problem for me the way I look at these things. Now, maybe other types of trades, it may make a difference. A lot of times in option view, I don't see, I'm sure you can manipulate the graphs to look like this, but whenever I see some other educator doing a session on option view, I'm seeing charts that look like this, and I'm like, well, that's great, but that's not really showing me any kind of granularity. So I'm sure that's just manipulating the chart. But again, I want it to look about the same. I trade in and out of Russell and IWM and occasionally the SPY in small accounts. And so my answer to make these graphs look consistent from one instrument to another is basically what I told you here. I expanded out so I can see every $10 strike, and then I want 3% up and 3% down to be somewhat at the edge of my screen, and that way the scaling is kind of consistent for me to discern the slope of this T+0 line. I know the gamma is a numerical number that gives me some sort of discernment as to what the slope is, but in my mind it's worked better to have a visual indicator. And anyway, I don't think you have to have option view to do what I'm doing here. I'm sure it would be a benefit for back testing and lots of other ways, and also for campaign style trades. I've had situations where, say I put one of these things on at 60, 90 days, time goes by, and sometimes I'll manipulate the back leg. Like maybe I want to go on get rid of that long September 30th and move it to September 23rd to flatten out my T+0 line. Well, that's hard to do in Thinkorswim. If you want to hang on to the short leg but change to the long leg, the bookkeeping in Thinkorswim goes haywire. And there's ways to simulate that, but it's not totally second nature. And in my case, I'm managing maybe 7 different accounts, and so it's just another way to screw up if you've got to hold a simulation open that illustrates your buying the long September 30th, then later on selling this September 30th for a possible gain or loss, and then moving that to, say, September 23rd. That's hard to do, and it would be better in option view. But really, for my purposes, Thinkorswim's work great. I have no complaints too much. So anyway.
So I've looked into it a little bit. I know that you can adjust the interest rate on Thinkorswim right there. Yep, that's the interest.
Yep.
But you can't go any lower than 0.01%.
Oh, it won't go negative?
No, you can't go lower than that. And also the dividend yield is fixed at 0.
Dividend yield, where is that?
They used to have a box here for that, but they took it off, and now it's just 0. I'm talking like in calculating the Black-Scholes formula.
Well, we're actually the Berks and Stinson or whatever it is. And I have not really played with toggling this around, but Thinkorswim defaults to that option model rather than Black-Scholes.
Yeah, Don could probably provide more details, but Black-Scholes is better for European style index-based options.
Right.
Versus the other there is better for American-based stock-based options.
And there's binomial as well. I just leave it on the stock settings here, and let me see. There's one more setting here in where is it? Calculations, volatility calculation mode, individual implied volatility, beta calculation fast. I don't know. These are the settings I use, and it seems to work. So I'm not really gonna get too into the woods on that. But for my purposes, it's worked great, really. And I'm partially managing with P&L. If my P&L is going negative, I know I'm not happy. And I'm managing with delta. I want a neutral-ish delta, and I'll stack them up either on the top or the bottom, regardless of current volatility levels. I want to keep a profit tent over that underlying price as much as possible. And occasionally, I have seen this happen where the T+0 line drops. Now, it's usually not a problem. We've had other speakers explain why they don't like calendar spreads. I've seen other trades do the same thing. A butterfly can have a situation where, let me see if I can simulate it. Yeah. So, I mean, this is almost going in another direction, but see, the change across the front and back legs is never exactly symmetrical, but this is simulating the situation of, okay, the volatility moves have conspired against us. We got a dropping T+0 line, so we're not profitable anywhere along the range here, which is a little upsetting, and I see this happen occasionally. I mentioned before, it's 1 or 2 months a year when things kind of go sideways. This is usually what's happening when it happens. My answer to that has been to stick with the plan, keep adding spreads, and if you can stay over where the market is with your profit tent, then eventually the positive time decay is going to bring that money back to you, and you'll be profitable. It's not a great answer, I know, but that there's ways to lose money with every single option trade there is. We make money by putting money at risk, and if you don't put any money at risk, you're not going to make any money. And so it's just the very nature of what we do as traders that some money's at risk. Sometimes the forces of nature conspire against you and you lose money, but you don't stay in business very long if you lose a lot. So, what I do is I just try to ride it out, and I'll add more spreads down here. And it tends to, in this case, volatility's moved against us, but if we added another one, we are adding at the current prevailing volatility levels, whatever that may be, and we're able to stay over the price, even if we're down some money on it. Let's just see what that would look like. Let's throw up another one here. And let's move, say the market's moving down, which would normally help us. So, see, I've noticed when volatility goes up, money comes into these trades. So that makes sense. There's a lot of debate about, or are these things really positive vega or not? And it's going to depend based on the volatility movements of the long and short leg, but I would say most of the time they are positive vega, and you usually get a bump from increasing volatility. But it's also going to depend on where your calendar is positioned in relation to the current market. If you had this trade on here, let's undo this volatility adjust. Say you had this trade on, and what was I going to say about it here? The volatility change. Okay, say you're in this trade here, and we get a wave of increasing volatility, which would be characterized by falling price. So price moves down and volatility goes up. And again, I know that I am running roughshod over the long and short, because the volatility changes are never symmetrical across the dates, but we just that's an unknown that we can't possibly know the magnitude of the change in volatility. We can't even predict future price movement. So how are we going to predict future volatility movement of some obscure options? But anyway, what I was getting at is increasing volatility usually helps you, and you'll see it by an increasing T+0 line and an expanding profit tent. And I think I've talked about this before. I traded this through the COVID scare last March, and these profit tents expanded exponentially. I was safe over like a 400-point range with these things, and it doesn't always work out that way because there's a lot of moving parts here, but man, it's nice to see when you get that volatility. Well, here you can see it as I increase the volatility here. This profit tends expanding big time. So anyway, I view volatility kind of like standing in the ocean. You've got waves coming at you. You're never quite sure how big or small the next wave is. It might knock you down, it might not. But it's something that we don't seem to be able to predict all that well. And so as long as we have this huge profit tent that we can trade around and stay under, and we're good either up or down for a pretty large range. In my mind, that's a great way to play because, say we're at all-time highs like we are in the market now. And, can we go higher? Sure, we can go higher. But I'm always a little wary of a reversal when we hit previous all-time highs. And so I try to use, bits and pieces of what I've learned along the way to make decisions. Because really these things, it's a day-to-day decision-making process. You might enter a trade according to the normal rules with 60 days on the front leg and 90 on the back, but you just don't know what the market's going to hand you along the way. And so we have to either adjust or get out of the way, or, sometimes take one off at a small loss just so we can reposition that money and stay in the game. And anyway, that's just some of my thinking, how I'm approaching this, and it's working pretty well for me. So I think it's a great way to play. When I first started trading, I was doing bull put spreads and condors and butterflies, and they all have their merits. But if you dive down deep, if you were to look at the monitor tab on, say, a condor or a bullish put spread, you're losing money on some of the legs and you're gaining money on the others. Okay, so on a bull put spread, you would make money on the short leg that you've sold, but you're losing some money on the long leg. And it's necessary to have that long leg for hedging purposes and margin management and whatnot. But you're always losing on the long leg on a vertical spread. And so, that's when it occurred to me, well, what if we lost not as much on that long leg? Well, how can we lose not as much? We can lose less on that long leg by moving it farther out in time so that you have this differential in time decay. And a month, works fine, but I've seen it work fine with 3 days between the front and back leg, like we've discussed. So what's optimum? I'm not sure. I think the long, slow trades are the best for a large sum of money, like September, November. Again, how do I get my Zoom has this little header that is hiding some of my buttons. All right, well, anyway. But, I'm managing with stuff farther out in time and stuff closer in. And so I'm diversified across time anyway. And the farther out stuff is going to be more resilient than the closer in stuff to big moves in the market. And anyway, that's just some of what I'm doing here. Anybody have any more questions?
Ryan, are there any in the transcript needs to be that you have seen that look interesting?
Let me see. Where is that? I'm looking for that. Hold
on. So somebody asked about your max drawdown and how much back testing have you done?
My max drawdown, I have lost, I want to close these things out before they go negative. So if the trade's gone negative, I'm closing it out. If I'm losing more than a few dollars, well, it's a screw up on my part is the way I look at it. But my max drawdown, well, I've lost some money along the way. Learning how to do this, but normally I'm not losing anything. Now, back testing, I haven't really done a lot of back testing. I do forward testing. We don't know that the market's going to behave like it did in 2009 or whatever. Certainly there's some value in doing that. I've just chosen to focus my efforts on the future. I feel like I've got some good strategies that have been time tested in my mind. Now, some hedging is prudent. There's various ways to do that. And I always recommend Brian Johnson's book on hedging. I like to keep some contingent orders out there for futures in case the market really takes a dump, and I can minimize my losses on the way down. But there's other ways to do that are probably beyond the scope of this discussion. But as far as back testing, you got to convince yourself that this is a good strategy if you want to do this, or whatever other strategy you might want to do. So if you, some personalities might spend 15 years back testing a strategy before that they really commit any capital to it. I'm not as young as I used to be, so I don't want to wait 15 years to get started trading. So I just decided to dip my toe in the water, and initially I didn't risk a whole lot, maybe $5,000. But as time went on and I made money, I committed more and more to the trades. And anyway, that's just my philosophy. But if you want to back test, I've got no problems with it. If it'll make you a more confident trader, that's fine. So anyway, that's just my approach.
Anybody else out there is welcome to turn on their mic and ask a question. And don't let those of us who have been making a lot of comments be the only ones. By all means, we want to be inclusive. So feel free. Mark, where would you say that the biggest mistake you've seen people make is, or what would you say it is? Where have they had the largest unexpected losses or just the largest losses?
Well, I'm all of these trades have the characteristic of a zone of safety followed by a zone of danger on the top and the bottom. And so, I mean, usually when people lose money, they're not following all the rules.
Okay.
The 100-point from at the money is that's one of my do or die rules there, that if you've put on a calendar spread and the market's moved 100 points away from you, you're taking that thing off, no questions asked, whether you're up money or down money. And you might be up money, or you might be down money, but that is no longer helping you once it's 100 points away. And so that's one thing I usually see people either they forget about it or whatever. So that would be one possible pitfall. Like I said, occasionally we get an adverse volatility move that conspires to drop this T+0 line. My approach has been to try not to panic. Oftentimes a big move down in the market is followed by an equally strong move up. So if let's just zoom in a bit here, but say that the big move down, maybe you're on the bottom end of your profit tent down here. I like to wait till the next day and see how the next day opens. See, I bet this, we had a strong move down here. I bet when the market opened up on this next day, we were strongly positive on this advanced decline. And so you wouldn't have, if you had adjusted to the downside on this day, you probably did the wrong thing and you got whiplashed and the market went against you in the opposite direction. So I try not to look at every market move as a panic moment that I've got to go make some adjustment, because oftentimes that it reverses, just like it did here, just like it did here, just like it did here. over and over, if you were to be too quick about adjusting, you got whiplash. You took stuff off the top and added it to the bottom, and then the very next day the market went the other way. And so I've found that this advanced decline has been a good barometer of the momentum in the market. But there's one more thing I'm looking at here, and that is the McClellan oscillator. And you can look that thing up and do some research on it if you like, but it is, and I'm not even sure I can explain it, but it's some kind of computation on the advanced decline. And usually, so it's the yellow line on this graph. If it's falling, then the market's falling, and we got to be more worried about the bottom side of our trades. But it's mean reverting, just like a lot of things in this business. And so, if it's falling, eventually it hits a bottom, and you can see where the McClellan oscillator turned around previously. And so I put a price level here, and wow, it's kind of lining up with at least 3 other instances of reversing at that level. And so if the oscillator is going up, well, we're more worried about the upside of our trades rather than the downside. So this is one more thing that I'm kind of playing with, but it seems to have some value, and maybe a little bit of a leading indicator as far as where things are going next. What I'm seeing here is it's got a little room to run before we max out on the range of the highs and lows on the oscillator. And so, I'm still concerned about the upside. I think we roll up a bit more over, the next few weeks. Now, this is not perfect, and I may be wrong, but I'm saying we move up till this oscillator gets to somewhere in these levels. And this oscillator may have nothing to do with the price. It's a scaling thing here, but I'm just looking at it to see, is it going up or down, or is it at one extreme or the other, and what level is the reversion going to happen? So I bet the market drifts up until this oscillator gets up to some of these levels, maybe even way up here. But again, that's not the price of the SPX. That's just the oscillator itself. Let me see. You can actually go, let's go back to our studies and hit this and go show it on the left axis. Hit apply. Okay. Now there's some scaling here on the left axis that relates to our oscillator, but I bet the market goes up to, you can see where it's turned around before at the top. And I found it has some bearing, and it helps me. I don't know if I would want to use something like this to make directional bets, but the great thing about calendar spreads is we're not really directional. We're working with this huge range that we can move around over time and still stay on top of where the money is, at the money is. And so, that's another thing I'm looking to decide. Well, am I worried about it on the upside, or am I not? If I had this trade on and I'm way up here, I'm obviously way more worried about this upside than the downside. I mean, excepting for some huge 9/11 style crash or COVID crash or something. I mean, it can always blow through the bottom, but it's a pretty long range before it does. And most of the time, the market moves up a few days, and then it moves down a few days, and then it moves up a few days. And so a lot of times, sometimes I don't even have to adjust, but you need to know how to adjust. You got to have that tool in your back pocket, because when you need to adjust, there's no time to learn how to do it. But anyway, just some of my thoughts here.
Well, it's great, Mark. Does anyone have any other questions for Mark or comments?
Let's see.
Does anyone have any other points they want to raise? I guess we're getting along in the evening, so does anyone have any totally unrelated topics that they want to get in at least a brief mention of? Mark, did you have anything else you wanted to add before we wind down?
No, I guess that's it. You know, if anybody's interested, I'm still doing some mentoring in this. I generally charge $100 an hour for an hour of my time on Zoom. And if you're interested, I will, you know, we can look at your screen, we can look at my screen, I can tutor you on some of the finer points of Thinkorswim or what I'm doing with calendar spreads or anything else that you might like. But it's not a huge money maker for me. It's just a little beer money. I make most of my money trading, so yeah, I'm not trying to build a huge business of mentoring, but I have worked with a few, and
good for you. And how would they get in touch with you?
My email is it's mail, M-A-I-L. Here, I'll put it in the chat.
Okay.
Mail Mosley at yahoo.com.
All right. Oh, there it is.
There it is.
So, yeah, thank you very much. I see a couple of people saying thank you very much, and certainly everybody feels that way. It took quite a bit of time, and sometimes it's just a matter of going over the details more than once before people really get the idea. And I think this helps them get the idea very much for trading calendar spreads. Anybody else have anything else? Okay, well, I guess that is the end. Thank you very much, and we'll see you next time. Thank you. Bye.
Thank you.
Thanks.